Treasury 10-year note yields had their highest settle since mid-August, and just recently got down as low as 142. Well, we're 20 basis points higher than that. Nothing has really changed in the greater macro picture. But what we've learned over that short-term week period, or roughly around a week, is that things are going to take time, and the short-term traders may be looking to cover some of those longs and treasuries, which they've been clinging on to, given the fact that we do have a little bit of time between now and FOMC, now and when the U.S. and China trade talks resume, now and when maybe the ECB changes or adds to its quantitative or its interventions over in Europe. Brexit's obviously not until the end of October, and now there's going to seemingly be some kind of a pause between when we find out the when and how that may look, some kind of resolution. So I think in the short term, yeah, we're going to see yields kind of creep up higher, but it doesn't change the macro picture. It doesn't change what's going on. Obviously, we got a mediocre jobs number last week, and we have a Fed that's meeting the 18th of September. That is really going to change everything. It's going to be that pivot point. I think that people are waiting to find out how aggressive is the Fed going to be, and how aggressive are they going to be about talking about maybe the next meeting, maybe the next set of expectations for December of 2019. That'll kind of be the way the market gears. So in the short term, between now and September FOMC, you could see a pretty volatile up and down trade. And right now you're starting to see some of those longs cover. It seems pretty natural to me to rally yields 20 basis points only to say, well, now we're going to probably start to see buyers come back in, but not until after FOMC if things don't go as planned. And if you look at market volatility, you would expect as we move back into the old range, as people get out of trades, as they sort of breathe a sigh of relief, volatility is going to come down, and it has become a very directional trade. So as yields creep up higher, we are seeing volatilities come back down. It's when we see those yields break into the areas not seen in a long time, all-time lows and new lows and whatnot, we start to see volatility bid. So volatility has definitely come off. With demand has come off for treasuries, at least in the short term, and that in turn has helped volatility come off as well. And if you look at what Fed expectations are looking for, they're looking for a less dovish Fed at September FOMC. There is no reason why things have changed here, other than we got a Fed. We got Mr. Powell spoke last week from Zurich. He talked about everything being okay and the Fed not having to act as aggressively, maybe, but it doesn't necessarily paint the picture that things are fine yet. And September 18th is going to be here before you know it. The Fed is going to have to maybe acquiesce a little bit to the market. They may not cut 50 basis points, but certainly they don't want to leave themselves in a corner that says we're done for the year, because I don't think the market says they're done, and I don't think the Fed wants to be done and go against the market. That has not worked well for the Fed in the past. And I think right now we get past that September 18th FOMC, things really start to get a little bit clearer. Treasury yields right now, which have been stubbornly low pretty much all going back to March, maybe see a little bit of a rise, but ultimately I think the global growth story, the China trade story, the Brexit story, those are all still going to be there, and that is really what's going to be driving trade at this point once we get past FOMC and maybe take the Fed out of the equation, at least in the short term. So right now, Treasury yields seeing a bit of a retracement higher, but for how long? September 18th will probably be the tell point and the pivot point as to the future in the year-end trade for Treasuries.